Right now, Applied Digital Corp, ticker APLD, is trading at $22.98, and it's down about 2.8% on the day. The stock has been bouncing between a low of $22.71 and a high of $24.67 on very heavy volume. And for a lot of people just glancing at their Fidelity mobile app or their Robinhood app, the expectation is simple. This is just more gut-wrenching volatility from a company that many still associate with its old name, Applied Blockchain. They see a stock with a beta of nearly 6.8, that's not a typo, 6.8, and they assume it's just a speculative crypto-adjacent play, a name to be traded for quick Robinhood fractional shares profits, not a serious investment. But that expectation, that narrative is completely missing the reality of what is happening under the hood. The reality is that just a few days ago, Applied Digital announced it was pricing a staggering $2.35 billion offering of senior secured notes. The stock sold off hard on that news, dropping over 10%, because the market expected this to be a sign of desperation or massive dilution. But the reality? That $2.35 billion isn't to plug a hole, it's the rocket fuel to fund the construction of its massive new data center campuses in North Dakota, campuses that are already being leased out on 15-year contracts to the largest hyperscale companies in the world. The market saw debt and panicked. The reality is this is the cost of entry to become a foundational infrastructure provider for the entire AI build-out. Most investors, especially those new to online investing or just starting with self-investing, are conditioned to see debt as a bad thing. They're taught by investment help sites to look for clean balance sheets, like you might find with Apple stock. But in the capital-intensive world of data center construction, debt is the tool you use to build the factory. And Applied Digital is building an AI factory. This isn't a company hoping for customers, it's a company scrambling to build fast enough to fulfill contracts it already signed. This is the central tension, the disconnect between expectation and reality that is defining this stock right now. The market is still pricing in the crypto mining past, while the company's order book is screaming AI infrastructure future. The volatility you see on your SoFi trading platform is the market trying to figure this identity crisis out in real time. It's a battle between the old story and the new one, and frankly, the new one is almost too big to believe. Just last month in October, the company announced a lease agreement for 200 megawatts of capacity at its new Polaris Forge 2 campus. The deal is for 15 years and represents on its own $5 billion in total contracted revenue. The customer was described only as a U.S.-based investment-grade hyperscaler. We know who these companies are. They are the giants buying NVIDIA stock in billion-dollar chunks, the very companies whose cloud services run our entire digital life. And here's the kicker. That same hyperscaler has the first right of refusal for the additional 800 megawatts at that campus. This one deal brings Applied Digital's total leased capacity in North Dakota, between just two hyperscale customers, to 600 megawatts. This isn't a speculative venture, this is a pre-sold, long-term infrastructure project. So let's look at the recent stock movement through this new lens. The stock has been all over the place, from a 52-week low of $3.31 to a high of over $40. It's not for the faint of heart. If you're using a SoFi robo-advisor or have your retirement in Schwab Intelligent portfolios, this stock is likely nowhere near your holdings, and for good reason. Its volatility is extreme. But for active traders using an individual brokerage account, whether at Fidelity, Interactive Brokers, or SoFi, this name is a lightning rod. The volume today is massive, nearing 20 million shares. This isn't just retail interest from Robinhood stock trading, this is institutional capital churning as it digests the implications of these massive financing and leasing deals. Just days ago, on November 12th, Macquarie Asset Management announced it was providing an additional $787.5 million in equity funding to accelerate the build-out. Institutions like that don't commit $750 million on a whim. They've done the due diligence. They see the 15-year, $5 billion contract and understand the construction timeline. S&P Global even chimed in, assigning the company a B+ rating with a positive outlook, specifically citing the long-term contractual framework that will support earnings visibility. This is the kind of language that professional Fidelity wealth management teams look for, even if they're balanced by S&P's warnings of construction risk and tenant concentration. That's the trade-off. The expectation is a small, struggling company. The reality is a $6.4 billion market cap company that is S&P rated and has institutional giants like Macquarie funding its build-out to fulfill multi-billion-dollar contracts. When you look at Fidelity ETFs or Fidelity mutual funds focused on digital infrastructure, Applied Digital is starting to look less like its crypto mining peers and more like a pure play on AI data centers. The company itself has made this pivot explicit. It was founded in 2021, and its old business was largely hosting services for crypto miners. That's a brutal, low-margin, high-energy cost business. The company's leadership saw the coming AI wave, driven by the same technology underpinning NVIDIA stock, and made a hard pivot. They are now, as they state, a designer, builder, and operator of high-performance, next-generation data centers. Their specialty is high-performance computing, or HPC, which is exactly what AI models need. They're not just providing empty rooms with power, they're building AI factories with proprietary waterless cooling designs engineered for the extreme power density that modern AI chips require. This is why they are winning these massive contracts. The hyperscalers can't build this specialized infrastructure fast enough themselves, so they're outsourcing it to specialists like Applied Digital. This is a very different business model than just being a landlord, and it's a world away from crypto mining. Of course, this pivot is not without immense risk. This is the reality side of the equation that bulls must accept. The $2.35 billion in notes is a lot of debt. The company is still not profitable on a GAAP basis with a PE of negative 21.75. Execution is everything. They have to actually build these massive data centers on time and on budget. S&P's report flagged construction risk as a key constraint. If they're late by more than 180 days, their hyperscaler tenant has the right to terminate the lease. That's a terrifying clause. This means the company is in a dead sprint to build, and any supply chain issue or labor shortage could be catastrophic. Furthermore, the tenant concentration is a real issue. Right now, their entire future is tied to just two massive customers. If anything happens to one of those relationships, the house of cards could wobble. This is why the stock trades the way it does. It's not a safe investment like Tesla stock or Apple stock. Well, maybe safe isn't the right word for Tesla stock, but you understand the comparison. APLD is a high-stakes bet on execution. The market is watching every construction update, every SEC filing, every new press release. This isn't a stock you just buy and hold in your Fidelity IRAs and check in on next year. This is a story that is unfolding daily on the Fidelity trading platform and the Interactive Brokers trading platform. So, what is the future outlook here? This is where the expectation versus reality framework becomes your most valuable tool for online investment. The bullish scenario is that the market's expectation is just plain wrong. The company is not a crypto miner. It's an AI infrastructure company in its infancy. In this scenario, the company successfully executes. It builds the Polaris Forge campuses, the hyperscaler tenants move in, and that $5 billion in revenue starts hitting the books in 2026 and 2027. The $2.35 billion in debt is successfully serviced by the long-term predictable cash flows from these contracts. In this reality, the current $6.4 billion market cap is absurdly cheap for a company with a 600-megawatt, 15-year pre-sold revenue stream from investment-grade tenants. If they successfully land the additional 800 megawatts from their anchor tenant, this company could be a $20 or $30 billion company in a few years. The analysts who have buy ratings and price targets as high as 41.50 are seeing this reality. They believe the execution risk is manageable, and the reward is astronomical. This is the kind of story that active investors using SoFi active investing tools or the advanced charting on interactive brokers trading systems are hunting for. Then there is the bearish reality. The expectation of the bears is that the company is a house of cards. It's a company with a history of pivots, taking on a mountain of debt that it can't possibly manage, all while being tied to just one or two customers in a highly competitive space. The execution risk in this view is insurmountable. Construction delays will happen. Costs will overrun. The hyperscaler tenant will use the 180-day late clause to terminate, or more likely renegotiate the lease at a much lower rate, crushing Applied Digital's margins. In this scenario, the $2.35 billion in debt becomes an anchor that pulls the company to the bottom. The stock's unprofitability and insane beta are, in this reality, the correct market signals. They are warnings, not